Do you ever feel like you're doing the right thing on your cards, making your payments, even paying extra, but the credit card balances just not move? That's when consolidation loans come in. But before you apply for one, you need to understand how they actually work because done the right way, you can save thousands. Done the wrong way, you can probably bury yourself in a deeper hole. This is Boomoo Kim. I'm an IAPDA certified consultant. Making the minimum payments feels responsible, but in reality, it just keeps most people stuck for years. If you got multiple cards, multiple high interest payments, a consolidation loan might simplify things. One payment, potentially lower your interest rates, and payoff date that actually just makes more significant sense. But there's a right way and a wrong way, so let's break it down together and see what that's all about for personally for you, your finances, and for your future. Now, a lot of people don't know about origination fees. It's a payment charge that basically that consolidates the loan that you're looking to request it as like a closing cost, down payment for the financial services that you're providing. So, if you're looking to request a loan for $10,000, the origination fee might range from 1% to 5%, depending on what you qualify for and what that financial institution is requiring when you request that loan. So let's just say I'm an individual who wants to request for a $10,000 consolidation loan, and my origination fee is 5%. So technically, the amount that I'm going to actually get is going to be $9,500 in reality because my origination fee, if it's 5%, $500 is going to be deducted from the actual loan amount. So in reality, I'm going to get 9,500 on the $10,000 that I qualify for. So it's very important, especially if you just use the cards recently, like yesterday, or pay off some balances recently. A lot of these financial institutions go based on the credit report. And the credit report, if you're someone who is on top of your bills, are you going to notice that it updates every 30 days or so because it goes based on the billing cycle. So it's very important to point out the loan officer or a loan consultant that you have in front of you that you have some updated numbers so you can actually request the loan amount that you're looking to get, actually pay the origination fee so you don't get shortcutted, overpay, and actually getting the loan that you're looking to request. Now, let's talk about some of the pros and cons. The pros is actually that you can bundle all the debts under one payment based on the you got the full amount on the loan that you got. They can do two ways once you get the loan and get approved. You can actually get it to direct deposit to your checking account. Now, my alternative way that most people don't know, and it's actually my personally favorite, is that they can direct deposit to your creditors. So, what does that mean? So, let's just say I have three credit cards. Let's say, just to make it easy, Chase, Bank of America, and Amex. Let's say the Chase, I have a balance of 3,333 and the rest of them as well. Let's just say I qualify for and ask for 10,500 and pay my origination fee. And I can actually tell the loan officer to direct deposit to my creditors so I can get the Chase already paid off, the Bank of America and Amex, instead of asking them to direct deposit to my checking account and pay off the creditors by myself. Because they have access to the credit report, like I said earlier, which has the information to who the banks are, the account number, the balance of the debt as well. So that's why it said it's important for you to know the actual balance of it so they can actually direct deposit that amount to directly to your creditors. And the only responsibility that you have as a consumer is just pay at your loan. So it's a really handy tool. It simplifies people's life for those who just have astronomical amount of credit cards and astronomical interest payments that you're dealing month to month. Now, let's talk about the cons about it. First of all, most people, what they don't know about a consolidation loan is that it's unsecured. So I always compare things to apples. Let's just say you're someone who's making minimum payments on your credit cards. Now, if you looked at my previous video, if you're making a minimum payments, depending on the balance of the credit cards, but most people have over $1,000 on it. That could take someone almost 10, 12 years if you're just doing the minimum payments on those. Now, let's just say you want to do a consolidation loan, you just want to simplify your life and you just want one easy payment. Yes, it will reduce your interest rate, but it will not reduce your payment. What do I mean by that? Even though it will reduce your interest rate. If you're a homeowner, I want to ask yourself, why did you choose a 30-year mortgage versus a 10-year or 15-year, even though the interest rates are lower on those, right? It's the most affordable payment that it gives you. Now, usually consolidation loans are 5-year terms. And if you look at these internet marketing companies that shares the interest rates, they're not really about like 8% per se. They're usually in the 20 percentiles because the loan is unsecured, which basically means there's no collateral to it. There's no actual asset tied to it except for your actual credit utilization to it. So all the risk is actually going to your credit, and that's why usually these types of loans have an interest rate that is 20% or higher. It could range from anywhere from 22%, which is the standard of it. Your payments on your minimums in order to be an ideal candidate, you have to be someone who's basically double or tripling your payments onto it. Because if you're someone like an individual just making minimum payments on them, you're just paying debt with debt at that point. Like the old saying people like to say, rob Peter to pay Paul. It's just a temporary band aid. It's not a permanent solution to paying off the debt. All I tell people is that you're just transferring balances to a bank that who you owe it to, rather than actually making significant progress to the debts. If you're someone who's just making minimum payments to it. Because, like I said, you're going from 12 years on the minimum payments on the cards all of a sudden down to 5 years. So if you're going from 29% to 22%, yeah, it reduces your interest rate, but your payment's going to become very aggressive because these loans are unsecured and they usually have a 5-year term. Now, if you're someone who has above $50,000 worth of unsecured debts, like credit cards, it no longer becomes a consolidation loan. Once it goes above $50,000, it becomes the level of a home equity line because there's some state restrictions that you can't borrow above $50,000. Like, let's just say I want to borrow $1 million to a bank. Usually, a consolidation loan doesn't qualify for that. So, once you go above $50,000 or you're an individual has almost $50,000 worth of unsecured debts, you want to look into more of a home equity line rather than a consolidation loan at that point. A lot of people might have a good credit score and they might say, "Hey, I'm making the minimum payments on it, but I never miss my payments ever. I always on time. If I did miss a payment, it was only just for 1 month." And still have a decent credit score like 650 or 680. Now, one of the biggest things a lot of people have a misconception is that the banks just only look at your credit score. They also look at the other factor, which is debt to income. You probably heard some friends or family members or acquaintances that someone has a 700 credit score, but they weren't able to get the house or car that they want, even though they have a 700 credit score. Why is that? Even though they always make on time payments and they have a reasonable credit score. Are you making on time payments, which is only 35% of your actual credit profile? They look at other 65% of other things, which is the other second big factor is debt to income. How much income you're actually bringing in each month, and what is the balance of the debt that you guys are carrying. So once you become over 30% utilized, that's when your credit score is going to see a steady decline. Now, if you're an individual who has it at 70% or plus credit utilization, so let's just say my example, like I have a credit limit of $10,000 under my name. And let's just say I have credit card balances of 7,000 out of 10,000 available credit. That means my credit utilization is about 70%. What that basically indicates in the bank size, the banks are the ones who's loaning the money, right? Once you become over 70%, that means you're becoming a risky lender to the banking industries, because that means about a lot of your expenses are very heavy credit based rather than actual paying off the debt. So if you're looking at those factors, that basically means if you're someone who's making minimum payments, who's on track record to pay 15 years, and you're not an individual who's able to double, triple your payments on your own, the bankers are basically saying that you have a really high chance of defaulting if supposedly a tire pops or you are off of work for 2 weeks, just because all of your expenses are just going to the interest rates and not actually paying off the balance. That's what a debt to income is indicating to the lenders. The banks don't only just look at if are you making your payments on time. They also look at the risk factor. Is this someone that is actually going to be lendable, not just only credit, but all the other things as well? Debt to income, credit history, credit mixture, and all the other factors that they look into as well. If you're someone who is not able to double, triple your payments and you're looking to get a consolidation loan, you're just basically buying yourself time. It's just a temporary band-aid. The double to tripling the payments, the reason why I'm repeating it very repetitively is because it's the gold standard on how and who qualifies for a consolidation loan. Because your payment's going to be almost close to that, even though, yes, it will reduce the interest rate, but no, it's not going to reduce the payment. Just like I said in the beginning, there's a reason why people choose a 30-year mortgage versus a 15-year term or 10-year term, even though those terms have a lower interest rate. Because the 30-year gives you the lowest payment and flexibility on your month-to-month budget. If you're someone who is not able to make those double or triple payments, unless you're someone who's getting like a quarterly bonus of a very aggressive amount or a yearly bonus that you're able to pay off the debts once you get that bonus, then yeah, you might be a good candidate at that point. But if you're someone who's even working overtime, asking for friends and family for money, the payments that you can do is just a bare requirement, then you're just someone who's just actually not going to get the benefit off of it and most likely going to get denials even though you might have a reasonable credit score. You want to assess that why is this happening? Like you want to go in the very beginning on how these credit card debts accumulated. Is it because you had a reduced income or is it because that your expenses are higher than the money that you're bringing in, or did you had an unexpected expenses? You want to know the root cause of why these credit card balances are there and why you're just making those payments to them, because if we don't find the root cause for it, then if we get out of it, we're not even really changing the symptom or the problem on why these debts are accumulating. One of the biggest things that happened to me when I got into credit card debt is because like I was a college student, didn't know anything about credit cards, interest rates, and wasn't making any income. So when there was like those months that I just needed to grab some food, I would just swipe it on the credit card. And scary enough, that one swipe that I did was just not only once, but happened repetitively because I was able to get the things that I want just like this. Now, it's important for you to know that credit was actually created so you pay off the balance of that existing month, right? Once you get your paycheck, not because you want to leave a balance behind it. So if you're someone who has a balance into it, not making significant progress, you want to find out why that's happening just so you don't get back to that position. Now, if you're someone who went through a financial hardship, which is an example, like I mentioned before, like medical, reduced income, job loss, or some type of natural disaster where you had to use your credit cards, then I understand because that means that you have to look at some other options as well rather than looking at a loan, because the loan is meant to pay off with your monthly expenses, not on a very high ticket credit utilization items. So that's something you have to keep in mind and understand that these 5-year unsecured loans has some risks and some benefits as well. And if you're someone who's just able to make the minimum payments and still wants to get out of debt sooner than 12 or 15 years, check out this next video that I'm going to talk about the next following topic, which is going to be debt relief.